Hi everyone, and welcome back to PR2170 Project Management. I'm Paul Tilley. Today we're looking at Part B of Unit 1, and this covers the material in Chapter 2, Organizational Strategy and Project Management. In this section unit, we're going to explain why it's important for project managers to understand the organization's strategy. We're going to identify the significant role projects contribute to the strategic direction of an organization. We're going to identify project stakeholders and how project stakeholders can be managed. And we're going to understand the need for a priority system in assessing projects. We're going to distinguish amongst three kinds of projects. The phase gate approach we'll discuss. We'll talk about the financial and non-financial criteria used to assess the value of projects. By now in your program, you've probably seen the concept of organizational strategy before. Generally, strategy is made up of several components. First of all, the organization will have something called a mission. A mission is effectively why the organization exists. The mission will then dictate some basic objectives, which are broad things that the organization does in order to fulfill its mandate. The objectives can be filled by creating a strategy, which is effectively a plan in order to be able to achieve the objectives. And this strategy will result in the development of specific goals. Here's what we want to do, and specific programs. Here are the basic things in terms of the various programs and items that we will do and the public will see. Strategic management flows out of this, and it is a process of assessing where we are and what we are. Strategic management flows right out of this process. It is the process of assessing what we are and deciding and implementing what we intend to do in order to get to where we want to go. So there's two dimensions of strategic management. First is evaluating what's happening out there in the external world that can impact us, and then allocating the firm's scarce resources to improve its competitive position and take advantage of opportunities as they arise. From there, firms must set out specific and measurable goals to achieve their stated mission. We implement the strategies and continually measure their relative success. Out of our basic mission and the strategy that we put in place are the goals that we want to shoot for. Here are the things we want to do. So business goals are what an organization wants to be, where it wants to end up at some point in time in the future. This kind of creates the vision. Each business goal you set should be framed as being specific, measurable, attainable, relevant, and time-based. And we use an acronym for that called SMART. So specific means that we make sure the goals are focused and identify a tangible outcome. So we want to increase our income by 100%. That's specific. Measurable. You should have some clear definition of success. By 100% is an example of a measurable goal. Attainable. Can we actually do it? So your goal should be challenging, but it shouldn't be out of this world. We should be able to reasonably achieve it. So can we reasonably attain a 100% increase? If we can, that would be an attainable goal and a suitable goal. Relevant. Goals need to be relevant. We need to get real with ourselves and what we do. And is this important to moving the company ahead? If it is relevant, that's a good goal. And finally, all goals need to be time-based. It's one thing to say we want to increase our sales by 100%, but if we don't say when we want to do that, then the goal is not that good. So we really need to be able to time-bound it. So every goal needs a target date, something that motivates us to apply our efforts in order to achieve it by a certain time. So from a project management perspective, once we've established how we can create some goals and understand what the organization's strategy is, we will come up with a series of projects that will help us move towards those goals. Okay? The question is, or the challenge is, do we or can we do all of the projects? And the answer is probably not. We need to be able to consider what projects are the most valuable to the organization and the ones that are most doable within the confines of the limited resources that we have. So managers need to ask, what projects can we fund? Does the company have resources to support them? Does the project reinforce the goals? Does the project make good business sense? And is the project complementary to the other company projects? So we really need to kind of narrow down our potential projects. All organizations must make a choice between the projects they pursue. Logically, organizations want to choose the most viable projects, and many project managers develop priority systems, and we're going to talk about these priority systems next. And the goal of these is really to balance the competing demands of time and advantage. And the pressures of time and money affect these major decisions. So, what do we need to do? Well, we need to choose. That's effectively what it comes down to. We need to be able to make a choice between the potential projects. So all firms face the problem of forced choice. It's the fact that we have scarce resources means that we have to choose. So the challenge lies in selecting the proper project that gives the most benefit for the least cost. If we think about some of the specific challenges in getting to that, though, it seems easy. Okay, we'll just pick this one, this one, this one. No, there are some challenges. We got something called an implementation gap. It takes a long time, or it could take a long time, to make a decision. And because there are many people in the organization with many different perspectives, that consultation process can take a long time. Out of that flow organizational politics. If there are 20 different departments within the organization, they all have a say into it. Those departments are going to have competing priority, and they're going to be jolting one another to do what they want happen. This is, by definition, organizational politics. It's common, it's just we need to manage it. And then we got resource allocation. It costs a lot of money to do a project, right? We need to allocate enough money in order to make it happen, or enough resources. And there's always a push-pull going on between how much should we spend, how many people can we dedicate, do those people have competing tasks? All these sorts of things add to the challenge. So resource allocation is a bit of a challenge. Projects tend to fall into three basic types. They're either strategic, operational, or compliance type projects. Strategic projects are the ones that we're most focused on. These are involving projects that really push the envelope and allow the company to grow and obtain its goals, okay? So a new product, new service, new retail location, new branch, new factory, all these sorts of things that would be considered as strategic projects. They also come with the most challenges. We also have operational projects, and operational projects aren't so entrenched because these projects may not produce radical improvements, but they probably reduce costs, they get the work done more efficiently, they might produce a higher quality product, they allow us to do the things that we do better. And finally, we have compliance projects, and compliance projects are projects that are forced upon us by government regulation or industry regulation. Okay, there's no choice about whether we need to do those or not. We're often told we must do them. So by the time that we get around to it, there could be several projects that we're forced to do, and we need to do those first, and that's going to have an impact on our ability to do the other types of projects. So again, legislation has forced us to do it. Those then move to the top of the priority list. So the fundamental question is, how do we select a project? The project selection decision process is helped with various models that exist out there that can be used, and these tend to be financial, but there also could be other forms of criteria that are used in order to determine whether or not to move the project forward. Generally, there are 6 issues managers should consider when evaluating screening decisions. That is it realistic? Is it capable of doing the job? Is it flexible? Is it relatively easy to use? Does it impose a huge cost burden or a small cost burden? And is it comparable with one project versus another? Are we comparing apples with apples? One type of methodology that's used in order to be able to assess projects and whether or not they're viable or not is something called the phase gate approach. And what it does is it breaks a project down into components, and it makes a decision gate, or basically a stop-go decision, at each of those stages. So the idea behind it is that if we can take a project and break it down into its components, and we say to the components could be like, here's the idea. We move from the idea to scoping it out. How big is it? What do we need? And then we say, okay, the business case. And then we say the development. And then we say the launch. At each of the planning stages, idea, scoping, business case, development, at each of those planning phases, we're going to take a stop and we're going to take a look once each of those phases are done. So gate 1, gate 2, gate 3, and gate 4 will occur in this example at the stop points. At any of those points, if it fails to meet the acceptable level, whatever is defined as the acceptable level, the project will stop. Generally, we can see these gates as applying certain criteria. And this criteria generally tends to be considered as either financial criteria or non-financial criteria. Okay, looking at financial criteria, this is dollars and cents stuff. We might want to ask, and you think back to your mathematics course, how long is the payback period? How long does it take before we get our money back on the investment? We could also think about the net present value. We use the time value of money to determine what is the present value of all of the flows of funds that are planning to come from that project. Is the money that we're putting in now, will it be replaced or covered off with the revenues that are going to flow in the future? Discounted payback is very similar to that, where we say, okay, here are all the payments. Let's discount it back to the present and say, is this more than what we're going to invest in the project? And the internal rate of return is analogous to the interest rate. The amount of money the project makes as it moves along, is it enough to generate a reasonable return that we could get relative to any other project we do? Is the return greater? From a non-financial perspective, in terms of decision making, there's a lot of non-financial ones, including things like, does it strategically align with our company, our organization, and our strategy? Is there a key driver, and is there someone moving this project forward? Does it meet the success matrix? In other words, we have defined what are the things that we would want to see a project be successful, good for the environment. Does it tick that box? Yes. Sponsorship. Is there someone behind this project who's paying for it, or a project lead? Is there a significant risk in the project? Do the benefits outweigh the cost? Do the culture of the organization allow for this to move forward? Is the approach right? Should we lease something? Should we buy something? Should we build something? Do we have the training and the resources available to move and make this project as viable as possible? And looking at the overall portfolio of projects that we have in our organization, does it match up with that? We also have multi-criteria models. Checklist models they're called. I'm going to look at a couple kinds of checklist models here. One is just a straight checklist, and the other one uses a weighted assessment. The first is the checklist model, and the checklist model, just basically what we do is we outline the things that a project needs to achieve. And we ask ourselves, does it meet those criteria that we laid out? Okay, it's fairly simple. So here's an example. In our company, key selection criteria are cost and speed. Speed to market, that is. Because of our strategic competitive model and the industry we're in, we favor low-cost projects over high-cost projects. And we need to be brought to the marketplace in less than a year. If a project is low cost and can be brought to the market in 1 year, that's a project they would look at moving forward. If it doesn't meet that criteria, we won't move it forward. Here's an example of the checklist applied to several different potential projects. So project alpha, beta, gamma, and delta. And again, using it cost, profit potential, time to market, development risks. Those 4 criteria, and we assess them as being high to low. So we look for the project that has the most high, in this case, project gamma, would have the most high rankings. Because of this, this is the project that we would favor. The ones with the least high rankings, project alpha, would be lower in the list. Now we can kind of put a finer point on this model if we use what's called a weighted scoring. So different criteria will be weighted differently. Okay, so we think of this particular example here where we got time to market that has a weight of 3, meaning it's very important. Profit potential, a weight of 2, development risk, a weight of 2, and cost, a rate of 1. So the time and the profit ones are more valuable than the development one and cost. So here we have to assign the weights, and then we do our assessment, and we multiply the assessment in terms of our score assessment with the weight, and we get a tally for a weighted score, known as a weighted score. Whichever ones that weight higher, in this case Project Beta, would have a higher ranking than Project Alpha. That would be the preferred project. Well, that's a quick overview of the strategy component of Unit 1. If you have any questions, please let me know. Thanks for watching.